I also do want to ask you about the president's new executive order that would potentially allow people to use money in their 401k towards things like crypto, private equity, buying homes. How would that work? How quickly could that take effect?
So it's super controversial because there have been roadblocks and guide rails against this for a long, long time, because the concern is a regular buy and hold investor, somebody who doesn't make a ton of money, makes the average amount of money, that they shouldn't be in these very risky, high fee parts of the market. So that they should be diversified inside their very regulated 401k. This would open up private equity, then would be able to sell to regular Joe investors these products that are very sophisticated with high fees and can be very, very volatile, like crypto and others. So on the one hand, people think this is a bit of a democratization. The little guy has a chance to get his money in where rich people play. But the concern among consumer advocates is that the little guy could really get hurt by something like this. So we'll see how it rolls out.
So that was NBC talking about Trump's latest executive order that would open up 401k investment retirement accounts to a broader range of investment types, including things like cryptocurrencies, private equity, real estate, and other types of less regulated investments that aren't publicly traded on the stock market. Now, there's been a lot of support and also a lot of criticism for this move, so please let me know what you think in the comments.
Now, Selena, the president has also signed an executive order allowing alternative assets into 401ks, including cryptocurrency. What do you know about that?
So, Stephanie, I just lost your audio there, but I believe you were asking me about this executive order that the president has just signed. So this executive order will allow 401k investors to access alternative assets, including cryptocurrencies, private equity, and real estate. This is just the president's latest move towards embracing digital assets, and it would be a big boost to the sector. This order directs the SEC, Labor, and Treasury departments to help investors get access to those assets by revising regulations in guidance. Now, this could open up a vast new funding source to managers of alternative assets outside of stocks, bonds, and cash, but critics say it could bring too much risk into people's retirement accounts.
And that is my main concern. The stock market is volatile, but it's not nearly as volatile as privately traded assets or crypto. Plus, the stock market, you can see pretty much everything you could ever want to know about a company. They have to be very transparent if they're going to be on the public stock market. And in theory, that means you don't have to invest in companies that you don't think are going to do well. But with private equity, you kind of don't have any information. You're going in essentially completely blind, hoping that the owners are being honest and that they won't just cut and run and take your money with them.
And Ted, on that same topic, what impact would allowing cryptocurrency to 401ks have on Americans' retirement savings? Is this a good idea?
It's going to be slow going. There were some private investments allowed back in 2020, and years later, we still haven't really seen that available on a wide scale. A lot of providers are reluctant to be early adopters here. They're worried about potential costs and maybe lawsuits or other consequences. So I don't think anything's going to change overnight. Now, if you want to have a small part of your portfolio in crypto, that could make sense. You can do that right now, even outside of things like 401ks.
And this is another reason that I'm hesitant to support this, is that all the things that people are touting that you'll be able to do with your 401k and your money now, you can kind of already do those. You're welcome to invest in private equity with your own money, and you're also welcome to invest in crypto with your own money. You are already welcome to do all of these things, but this is pushing money that was already in retirement and probably growing really well if you look at the returns of the stock market into assets that might perform really well, but they might also just crash and burn and take your savings with them.
Diversification ultimately is a good thing, but you can achieve that in multiple ways. It doesn't have to be in the retirement plan. You could, generally speaking, index funds are the best way to go for the average person. Just kind of keep it simple, match the market over time, get low fees. You want to have 5% of your portfolio in crypto. I mean, I could see some utility in that, but I don't see big changes anytime soon.
All right, something to watch. Selena and Ted, thank you both so much. Really appreciate your time.
And diversification is absolutely essential. He's completely right about that. But I'm really not sure that this is the best way to achieve that. You can already diversify really easily and cheaply and really quite safely too. Looking at this retirement calculator, if you're currently 21, you make around $60,000 per year, which is the median household income. Half of people make more than that, half of people make less than that. You save just 10% of your monthly income and you expect to retire at the age of 67, and assuming an 8% return, which is about right, you would retire with about $3.2 million. This is not only a pretty good amount of money, more than enough to retire on, but you achieve that through the public stock market, which has tons of regulations and transparency laws, which help it be something that you can trust. Private equity doesn't have a lot of those same regulations, and that's why I'm worried that this is not as good as it seems on the surface. Now, there are some use cases where you're an incredibly smart financial investor or an advisor, or you have access to information that most people don't bother to look for. And in that case, you might actually really benefit from this. But I think most people are far more likely to fall behind than they are to get ahead. Because retirement accounts, as they stand, actually work pretty well. And private equity firms are also pushing really, really hard for this, saying that it's a great idea and it will be outstanding for the American people. And anytime private equity firms are really pushing hard for a good idea, that's an immediate and huge red flag for me. I do not trust private equity firms to have the best interests of citizens at heart.
And now this, President Trump is signing an executive order today that could shape how Americans save for retirement. Now, critics are warning that it could add risk to retirement savings. Dagan, I got to talk to you about this. I know you're a big fan of this topic. I get tired of hearing from those people who say, I'm okay to invest in cryptocurrency. I'm okay to invest in private equity, but you American person out there, not so much. What do you say?
It's your money. You should be able to do with it whatever you want. The only reason it's just sheltered in this little egg called a 401k plan is for tax purposes. It is yours. It belongs to you. You should be able to invest it however you see fit. That is all. Full stop.
And this is the big argument that I hear. It's yours, do what you want with it. And I'm honestly not opposed to that at all. I'm really not particularly in favor of government bodies or organizations coming in and saying what you can and can't do with your money. What I'm opposed to is taking a relatively safe retirement vehicle like 401ks and opening them up to potential bad actors to try and scam people. I'm not opposed to people doing what they want with their money. I'm opposed to private equity potentially doing what they want with your money. And this gives them potential access to that.
Charles?
I can't add to it. Full stop. I mean, the industry has underdelivered. They've overpromised and underdelivered for a long time. And there are a lot of people out there scratching their heads like, man, I've been in this thing for 20, 25 years, and I'm not getting what was promised to me. I think if people need to take control of their own financial future.
Well, Jackie,
here's this target date fund. You know where you can put that target date fund now. Sorry. Go
Jackie,
ahead.
People talk about the returns on their money, but the problem is they take their money out. And you're not going to make money. You can't see your 401k grow if you're constantly taking out money because you're moving or because you feel like it. Some of these uses, I think, are kind of questionable.
Taking money out of your 401k is kind of one of the worst things that you can do financially. I get sometimes you absolutely have to do it, but in most cases, you don't. And in doing so, you are costing yourself literally hundreds of thousands of dollars in the future. And if you've spent your whole life pulling out of your 401k whenever you feel like it, instead of letting it grow, then when you retire and have no money, who do you think it falls to for the rest of your life to take care of you? Yeah, the taxpayers.
Yes, I agree with that. And I never recommend, if anybody asks me personally, should they do that? I never recommend that they do. I don't really see a great case for it. But also, wouldn't you rather invest pre-tax dollars instead of paying tax on the money, taking it out, and then investing in crypto or whatever? I agree with Dagan. If people want a more diverse set of assets that they can potentially invest in, or if that's their pocket of money that they've said, that's my investment money, what I am pulling out and paying tax on is to save for my down payment, to pay my daily, expenses, to save for a vacation or whatever, then it's different and it's separate. So I'd like to see these accounts allow more access and more options. Obviously, you want people to do it responsibly and to be educated and informed when they're making those decisions.
David,
and that's the concern. I think one, people can already do that, where they can do whatever they want with their money. But two, I'm not convinced that people will be educated or making good financial decisions. And I think that trillions of dollars of private equity people will start coming out of the woodwork and trying to persuade you to make bad financial decisions that harm you and benefit the private equity. All the things that she says that she wants people to be able to do, I'm actually in favor of, but you can also already do that. The government isn't forcing you to have a 401k. And this is why I am conflicted. On the one hand, people should absolutely be allowed to do what they they want with their money. The government doesn't necessarily need to be involved there. But on the other hand, you're telling a bunch of private equity firms that there's now 10 or 12 trillion dollars in 401k retirement assets that are up for grabs. Private equity firms are going to see that, and they're going to start targeting individuals to try and trick them into investing in private assets so that they, the private equity firm, can get a cut of your money. At least when it was invested in the stock market, there were natural guardrails in place and also government regulation that were keeping your money relatively safe.
Let me sneak in here for a second before I go to you. You know, the Wilshire 5000 is actually 3,000 stocks. Part of the problem here is there's not enough to invest in because people don't want their companies to go public because you get all this regulation and you get everybody staring over your shoulder.
But who's been investing? I'm sorry, I got to cut in here because who's been investing my Social Security money for my entire life? I'm about to dip into that Social Security money. You know how much I'm getting? 1.5% a year. That's
just a point of clarification. Social Security is a fund. It's not necessarily an investment. And it's important that it's a fund and not an investment because if you invested it and the stock market went down, then you might not have enough money to pay people out. And if you invest in the stock market goes up, then you've got a bunch of extra money that you kind of don't know what to do with. It would also create a lot more inflation to invest Social Security because it would start pumping trillions and trillions of dollars into the US stock market and people wouldn't be able to keep up with inflation.
That's on the upside of their.
And you were promised like 8%.
What is you're the expert here. What is an S&P fund? Just an amalgam of like the SPY Spider. Over the years, over the decades, if I just put it in there, I would get what, about 8 or 9%?
Right.
8 or 9%. Right. And the government who is telling me how to invest my money, because they're politicians now that are opposed to this plan, they know more about investments than I do, forget about it.
We got to jump.
I'm just worried about the complexity that this adds. If you're a financial expert, this might be the best thing in the world for you. Suddenly you have way more options with what you can do, and if you're really shrewd and good about your money and familiar with people that can help you out with this kind of thing, you could stand to make a ton. But if you're an average person, then suddenly you have a ton of greedy companies that will come flying out of the woodwork and do anything they can to persuade you to give them your money. And I think bad actors are going to be able to abuse this a lot more easily than good actors are going to be able to benefit from it.
What it could mean for you and your money, let's ask no one better than CNBC senior personal finance correspondent Sharon Epperson. Sharon, we've talked about crypto and retirement plans, and I guess there's you could do some of this now, but a lot of people aren't doing it because they're concerned about the fiduciary and all the rest of it. If this now becomes a bigger, safer thing to do, just walk us through how it might work, what the options to people might look like.
Well, what we're talking about is the president perhaps giving guidance to the Department of Labor and the Security Exchange Commission about how this could work by putting private market investments into target date funds, into balance funds within a 401k plan. And so this is something that Trump has been signaling he's very interested in since 2020. He sent an information letter out, the Department of Labor under him, saying that this could be an additive to 401k plans. The way that it would work is when you look at the amount of assets that are available in the 401k industry, some $12 trillion in assets. There is a lot of potential for those who have private market investments to want to have them in 401k plans.
And private companies are just salivating to get their hands on this. That's $12.2 trillion right there that they view as up for grabs. And right now, that money is relatively safe. Sure, there have been absolutely major ups and downs in the stock market. But if we look at, say, the S&P 500 over the last 29 or 30 years, you're up 750%. If you had been playing the long game and investing since the 1990s, you would have seen pretty significant returns and you would have a pretty sizable retirement account, partly in thanks to your 401k and the fact that it's tax-free. As long as you've been responsible up to this point, you've been doing well without private equity getting their grubby little hands on your money.
The reality is the average account balance for a Fidelity 401k holder at the end of the first quarter was $127,000. And we're talking about just over $10,000 for a Gen Zer, if you look at different generations, and almost $250,000 for baby boomer. So the way that would work is for investors who have more sizable assets.
That's what I was going to ask. So not everybody could access.
Everyone will be able to access it.
Not just accredited?
But the people who are not just accredited investors, but the people who it probably would be best for, based on the financial advisors that I've spoken to and you have as well, would probably be those who have significant assets already.
In our interview yesterday about energy and energy infrastructure, Larry Fink of BlackRock kind of alluded to this. He said, well, soon and I'm paraphrasing, I should have the direct quote, so I don't want to screw it up, but it was something like, well, soon we're going to have access to private capital in your 401k, something like that. BlackRock and firms like that would benefit big time if this were to happen.
They would benefit big time. And so that's why firms like BlackRock, Apollo is also very interested in this. Even there are some retirement plan providers who are saying, yeah, this makes sense to do, like Empower. They want to make sure that that's available to their 401k holders to, as they would say, level the playing field.
If BlackRock is saying something is a really good idea, that puts red flags everywhere for me. They are focused solely on profits. If they're making money causes you to make money, like it does with their investment vehicles, that's great. But if they're making money causes you to lose money, like with Blackstone, their sister company, buying up a ton of real estate and then jacking up prices, then they'll do that too. They don't care about you. They care about money. If helping you gives them money, they'll do that. If hurting you gets the money, they'll do that too.
But there's a lot of controversy over, if people don't understand today how a target date fund works, right as it stands now, or maybe not even how an S&P 500 fund works. They're just defaulting into whatever the default is for their plan. Adding something that is an alternative investment that is less liquid, less transparent, that has high fees. Not sure if this is something that is truly for everyone.
I mean, I worry a lot that it's basically great for the industry and this huge, huge win for private equity, private credit, and all the rest of it. I'm not sure there's enough of a track record to say this needs to be part of anyone's retirement portfolio. Right. Also, because in a way, this asset class is still so young. It's like when we say America is still young. You know, relative to the stock market, this is still very young, and it hasn't been tested through many, many, many decades of returns in order to know kind of what position exactly it should occupy and why.
Well, the private equity market being unproven is kind of only semi-true, but some of the data that we do have about it is not great. Private equity takeovers have been blamed for the terminal declines of dozens of well-known businesses and the associated job losses, including J.Crew, Kmart, Sears, and BHS. According to one frequently cited analysis, 1 in 5 private equity-owned companies go bankrupt within 10 years of acquisition, a rate 10 times higher than that of publicly owned companies. You are more likely to lose your money working in private equity and giving your company and money over to private equity by a factor of 10 times. That's crazy. And it's not because private equity tends to target companies that are already weak. Often these businesses were thriving before being consumed. No one wants to buy a company that's shrinking, someone said. Ultimately, making these companies more efficient, quote unquote, often means little more than raising prices and lowering quality. In his book Plunder, Balu focuses on the example of U.S. trailer parks, which major private equity firms have been amassing with the avidity of an 8-year-old playing Monopoly. Once they own these low-income residential communities, the firms jack up ground rents, transfer utility costs to residents, and cut back on maintaining vital infrastructure such as sewers. Private equity leeches money out of companies all of the time for the sake of enriching themselves, and I'm worried that when you give them access to 401ks, they'll start doing the exact same thing there as well. Their track record is not good. To assume that they're going to suddenly become responsible with your money when they've been irresponsible with other people's money and companies in the past is just naive.
The concern that financial advisors I've spoken to say is that people are always looking for a quick fix. And so I haven't saved enough. Maybe this will help me meet my retirement goals, not understanding all the challenges. The other concern is, are they getting independent financial advice, not from a plan provider, about how this fits into their whole financial life?
It's just going to become the next big get-rich-quick scheme. And get-rich-quick schemes are everywhere, and millions of people fall for them all the time. This creates a new way for those scams to become more legitimate, and it will encourage people to fall for them at a rate that we have not yet seen.
Less safe, less predictable, and much more importantly, less transparent.
Currently, private equity's biggest investors are large institutional investors, pension funds, foundations, and foreign government wealth funds, which can afford the higher fees charged and the longer times the investors' funds are held.
Private equity investments require less public, in fact, no really public distribution of information about the financial health of the investment.
401k companies would just love to have all of this new business, but they do have a problem with private equity firms, and that is that 401k companies have a fiduciary responsibility to put the customer's interests higher than their own. That isn't necessarily the case with private equity.
Private equity really isn't regulated very much at all. They can do a lot more things to cook the books a lot more easily. And again, this is not an issue if you're an expert. But if you're in your 70s and you're just looking to retire with some money, then you stand to lose way more than you stand to gain.
The Trump administration has announced they are finalizing an executive order which will now allow you, wait for it, to invest your 401k, so it's your allocations in your 401k, into private equity. Do I need to explain why I say RIP to 401ks? Normally, people would say, well, this is awesome because how many people have wanted to invest in private companies but can't? The average person doesn't get access to private equity. They don't get a chance to invest in what the big boys do because it's off market. That's how they're going to write this out. What this means is it's going to allow people who are wanting their 401k to grow a little bit quicker, thinking let's go a little bit more risky, and they are going to invest in private equity. The reason that this is, in my opinion, this is happening is not for you. This is for private equity companies because they need your money to keep buying. And if they fail, they need your money because you don't even know what you're buying with private equity. Basically, this is going to turn every 401k owner is now going to have a LinkedIn profile who says they're also a venture capitalist. So again, I'm not here trying to police people. People have the right to do whatever they want with their money. But I feel like I already know that the reason that they're allowing this is not to help the consumer and the American person. It's to give private equity more liquidity.
This is about where I land. What you would like to do with your own money, I think you should be able to do. But I also think that you should have a safe place to put it without thinking or worrying. And private equity has no transparency, and therefore they have no trust. So they shouldn't be involved. Lots of people have a reasonable argument that 1, they don't trust the government and politicians to tell them where to put their money, and 2, they should be able to do whatever they want with their money. And I agree with that. I don't think politicians and governments are particularly trustworthy, but I think private equity firms with exactly one profit-based focus in mind are even less trustworthy than the government. Now, I know that people are going to bring up that, well, other countries allow retirement investments into private equity, and that's true. Canada does, the UK does, Australia does, the Netherlands does. Lots of very liberal-leaning countries do this already, but all of those countries have far stricter laws around business equity and transparency laws so that you know where your money is, and it's far harsher on companies that fail or lose people's money. And for anyone that says, well, this is good because the little person can now do what the rich big people get to do in investing in private equity. And that is correct. But rich big people, first of all, have huge teams of accountants and lawyers and mentors and advisors and business people at their backs. And on top of that, if they lose $1 million in one investment, who cares? They have $1 million more in a bunch of other investments. If you lose $1 million in your investment, that's all of your money. So if this does come to pass, please, I'm begging you, do not allocate any money to private equity. Thanks for watching.